Hello, my name is Ryan Brailsford. I'm Head of Sales at Pepper Money, and in this webinar I'd like to talk about life after COVID-19, the impact that we've seen on the market, but also where I feel the opportunities are as we come back out of this period. So we'll start there by looking at the impact that we've seen so far on the market from both a customer, a broker point of view, the changes we've seen in lender underwriting, but the ever-growing specialist market I really want to cover off where I feel the opportunities are as we come back out of this period there, and then my call to action, my mission if you choose to accept it. 2020 for me has very much been in three categories so far since the beginning of the year. Started off absolutely fantastically, didn't it? First couple of months, everybody was reporting record months, brokers have never been so busy. We'd really kind of come off the blocks from Christmas very, very quickly. And it felt like maybe we'd had a little bit of uncertainty in quarters 3 and 4, around Brexit and things like that. I don't know if anybody remembers Brexit. It's the thing that was in the news before COVID. But obviously, we'd got going from that, and whether it was the way that you voted or not, we had a decision, we had certainty, and I think we really got going again. But then, of course, out of nowhere, it certainly felt we were suddenly in lockdown, and the impact of that, of course, to our lives, not only in our business lives, has been absolutely significant. And the biggest one for the housing market was that people physically couldn't move. They couldn't move home, non-essential travel, and that valuers couldn't go out. So any lender relying on a physical valuation, even for a remortgage, that was going to put a complete stop. So it really did change the way that we were used to things operating overnight. And in addition to that, of course, we all tried to ship ourselves home. All of the companies, from a lender point of view, from broker point of view, everybody was sort of making sure their technology was in the right place to be able to continue to operate, but with nobody in the office. So it really has been an interesting time, I think, for everybody. But of course, now we are on our way back out of it. We're not in that sort of full lockdown anymore, and there are green shoots. There is light at the end of the tunnel. But some of the learns and some of the things that we've done to adapt to the period that we found ourselves in, I think we'll definitely continue to do. And I think from a technology point of view, it will definitely change the way we work moving forward. Simply put, I think it's really important to acknowledge that the UK mortgage market has changed. The way that we work has changed. And a lot of that, of course, has been forced. We've had to suddenly get ourselves into a position where we can continue to operate. But now we'll start to think, right, you know what, I want to go back to my office and I want to be able to see people. But actually, this time has taught me that I can be more productive if I also incorporate a little bit more video conference, or I do a few more things over the phone. And customers are going to be thinking the same things. And of course, everyone's lives are different, everyone works in different industries, and they'll have had changes to their working life that they'll now want to bring into their personal one. So I think the customer expectation is what will drive the way that the intermediary market works moving forward. It isn't up to us as lenders or even you as intermediaries really to decide how we need to shape our offering. It's down to what the customers want to do in terms of dealing with both of us. And I think that will definitely take a shift and technology will take a bigger part in it. Moving away from working from home and the people restraints, the other two big changes that we've seen in the way that we're operating at the moment fall really into two categories. It's either operational capacity for lenders or it's funding. And for some it will be both. And that's been a real trying time for us all, hasn't it? I think there's a big reduction in the amount of products available. From a mainstream point of view, it's very much operational capacity, and that kind of okey cokey that we're seeing at higher LTV at the moment is a big example of that. Lenders really want to support intermediaries, they really want to support customers. They're bringing 90% back, and of course they're getting absolutely flooded because they're the only ones doing it. So they're having to pull out, and we're seeing that kind of in and out, in and out. And the specialist market's no different, but for different reasons. For non-banks like ourselves, there's a funding issue. We rely very much on being able to securitise the loans that we originate, and that kind of debt capital market has been very impacted. So everybody's had to slow down and be a little bit more careful. Some lenders, of course, have withdrawn products, they've tightened criteria. Some have stopped lending completely. Now, I'm really proud to say that we haven't done that, and throughout this period, we've continued to lend to new customers. But of course, we've had to make some changes, and we've had to be a little bit more careful. We saw obviously the pause in physical valuations. And that certainly affected us originally, so we were trying to sort of underwrite cases, but then they were hitting that bottleneck of needing a val. And of course, just like every other lender, we were inundated with the payment holiday requests, the payment deferrals, and We wanted to make sure that we dealt with our customers in the absolutely best way possible. So we lent a lot of our staff to that team, and made it a real priority. So they were some of the real big impacts that we saw from a lending point of view in the first few months that are starting to slow down now, of course. We continue to keep in contact regularly with our customers who were on payment holidays, and helping them to get back to making those payments again. But of course, the big influx has gone. The valuers are back out. So we're just able to sort of tick over, a bit more of a normal world now as we start to return to normal. And as we do start to return to normal, lenders are having to ask more questions. And that's to be expected, of course. Nearly everybody has been impacted in one way or another by the current market. And we just need to understand from an underwriting point of view what position they're in, what that impact was, and of course that they've got that kind of ability to pay in the short term as well as the long term. The most important thing really, and this is where the key opportunity comes in for you, is that there's never been a better time to get advice. Professional advice now for people in this very changing market is so important, more so than it's ever been. We did a bit of research last year and then also updated that in February this year with YouGov, and it was around adverse credit at the time. And we asked 4,000 people, customers in the market, who'd had adverse in the last 3 years, what they would do in terms of looking for a mortgage. Now, the good news is the amount that said they would speak to a broker has increased from about 40% up to 57% when we did it in February. So 57% of people are coming to brokers, which is fantastic, when they feel that they've got something a little bit quirky that might mean it's more difficult to get a mortgage. But of course, it does mean the other 43% aren't. And when we asked what they were doing, they were speaking to their current lenders, so they were, their current bank, sorry, they were going to their mainstream bank and saying, can I get a mortgage? And if they said no, they were calling it a day. But of course, they were also getting advice from friends and family. And that's the difficulty. Frank down the pub. You all know Frank down the pub. He's the one that gives your customers bad advice day in, day out. And usually they come to you a little bit later and you wish they'd spoken to you first. Now, Frank's been a little bit quiet, of course, recently because the pubs have been closed. But he will be back. He will unfortunately be back. The pubs are now open. Everybody will be talking to Frank. And of course, there will be more and more conversations around people's changing circumstances, because in one way or another, everybody's have. Not only are there a lot of people obviously who've been furloughed, they've been on the government job retention scheme, there's unfortunately been job losses, there's been a huge impact for employed and self-employed, there's been a huge impact even to those continuing to work in the way that they continue to work. And it's obviously, it's a hot topic for people. And outside of that, of course, it's mindset. It's actual mindset. And spending so much time in the house, people have started to think, oh, do you know what? I've been here more than I usually am. I really do want that new kitchen, or that new husband, as the case may be. There's changes to work life. People don't want to commute anymore. People might be thinking, do you know what? If I'm not going to be in my London office every day from now on because my business is already making noises towards working a little bit more flexibly, then maybe I can move out of this apartment. Maybe I can move an hour out and have a garden. And of course, that, those kind of shift changes in people's mindsets have been so significant over the past few months, and we're going to see that move into our world and where we can help them. But that advice is so important. Even if that particular customer has always been very mainstream, never really had any issues, never had any adverse credit, now of course the impact from furlough schemes and things like that has been important, and they need to sort of reevaluate their finances. And like I say, they're reevaluating what they want their lifestyle to be, and their money needs to back them up in that. So advice from you is so important, and we all need to sort of really stress that to the market. 9.4 million employed adults were placed on furlough as of the 9th of July. That's a quarter of the workforce. In addition to that, from a self-employed point of view, 50% of self-employed individuals have actually taken one of the government scheme helps as well. So it really is a huge impact on our incomes at the moment. And that, of course, is why lenders need to be more careful. They need to be more careful, especially into early next year, the end of this year, around the lending that we do, and making sure that it is affordable. And the best way I can put it really is to imagine that the affordability model has taken on an additional layer. So we're not just looking at the long term, but the short term as well. Now, of course, from the previous crisis, we go back to 2008, affordability has been an absolute foundation for the way that lenders look at cases now. We learned our lesson. We know that at that point, people were being lent money that maybe was a bit too much for their income, especially if something was to change. Lenders had an obligation to lend responsibly and within an affordability model. So think about it as almost as a new layer of that, and there's an affordability model that's short term. What we need to be really clear on is that if people have been affected by COVID and their income has either reduced, whether that be because they took a pay cut but remained operational, whether it be because they were on furlough, and of course if they were self-employed and unable to work, we need to see that they're coming back out of it. So employed's quite straightforward, isn't it? You've been furloughed, you're back at work, you can see that on the pay slip. Self-employed is more complicated, unfortunately, because we need to be really sure that they're operating back at the level that they were. So I think the main questions to ask when you're speaking to customers is, there's nothing wrong with having taken the government help, of course there's not. But what an underwriter wants to see is that what we're basing the loan on, the money that we're basing the loan on, is actually their trading money, and not that they're just chipping away at that lump sum that they got from a bounce back loan or a grant. That's the big thing. So it's seeing that they're back up and running and knowing that the customer is going to pay, of course. Because payment deferrals, of course, every lender has given a lot of these, a heck of a lot of these for customers to help them through this time, which is absolutely right. But of course, no lender wants to complete on a case at the end of this year for them to take a payment holiday in their first couple of months of actually completing. I think what that would show us from a lending point of view is that we didn't underwrite it properly in the first place, and that it wasn't affordable and wasn't good advice. So there will be more questions asked from an underwriting point of view, and as I say, that is to be expected. The best thing to do, of course, is preempt it. Ask those questions yourself, speak to the customer, explain to them where lenders are coming from. The real benefit, of course, for lenders like ourselves in the specialist space is it's individually underwritten, and it always has been. So you're dealing with human beings. You'll be able to have that conversation, explain the customer's situation. And I can't stress enough how helpful that is for us as well. So if you're doing a decision in principle, you're doing a full application, put notes on it, explain the background. And the real benefit, hopefully for you and for your customer, is that we can take those notes into account and we can have that conversation. It isn't a computer-led decision. Individual underwriting has probably never been so important, and we'll obviously continue to do it. And we'll also continue to look at the market and what the customer dynamic will change. I'm sure it will change coming out of COVID, and we need to make sure that we adapt to that as well. Now, as we start to come back out of this, we feel we're going to be left with four types of customer. The first category is the uncertain customers. So these are the ones who maybe are in fear of redundancy. Maybe they know it's going to happen. They're sort of working on a timeline for that. Self-employed business owners who are seeing a struggle and they can tell that it's going to be a while before, unfortunately, they get back going again. They're at risk of experiencing impaired credit, certainly if those things are to happen and their income dries up. So they're very uncertain in the market, and they definitely need a bit of help in what the best things to do with their finances are at the moment. Then of course there's the curtailed customers. Now these are the ones who've maybe been on furlough, and it could have been, for the majority of the year by the time the scheme finishes at the end of October, they've been receiving lower levels of income. And they may have been struggling because they've had less income to pay the bills. Maybe they were living, relatively highly geared in terms of outgoings in the first place. They may have borrowed their way through the situation. Whilst there's lots of government support available, there are people who don't want to take it or haven't been able to take it for one reason or another, and have wanted to just use their available credit in order to get themselves through this situation. And now, of course, that can cause one of two issues. One is either they have then missed payments on those credit cards and things that they've used to borrow their way through it, and those odd missed payments, of course, will affect them in the mainstream lenders. Or they haven't missed any payments, but their indebtedness has, of course, increased, and then they're over indebted and they're failing credit scores. So again, the specialist market can certainly help with that, and they're the kind of customers that need to be speaking to you to make sure they're doing the right thing. Debt consolidation may be the way out of it once they know that they're back in a more certain employment and their incomes rise again. Then there's the troubled couple. Now, unfortunately, this is one that has been affected already quite significantly. So maybe out of the two, one of them has been made redundant, and that's had a significant impact, obviously, on their income and on their finances as a whole. And it's good to sit down with you and review them properly. It may be that actually there's enough affordability there for the mortgage in order to remortgage them in one name. They could be sat on an SVR, they could have been overpaying all this time, and you can really help them to get through this. Obviously helping them to budget on a monthly basis. And then, of course, as we get to the sort of end of that process and maybe they're back in work, looking to protect them against this for next time. Of course, you'll find during this period a lot of customers are seeing the benefit of the protection that they didn't take in the first place. And it's a really good time to revisit that with them and say, if this was to happen to you again, you would be in a different situation because of this policy that I can recommend. But finally, we have the customers who haven't been financially impacted. Haven't been financially impacted at all. They'll be in roles where they can work from home, industries where their businesses weren't affected at all, so they've continued to earn as usual, but actually spent less because, of course, they haven't been able to leave the house. So almost forced savings. They'll be better off at the end of this than they were going into it. And then they may look to take advantage of the situation. We've got the stamp duty break. They may think now's definitely the time to upsize. They've put a bit of money away. They may decide that home improvements, this is the right time because, again, they've got half the cash together. So if they maybe remortgage to get the other half, they can get that kitchen they always wanted. Or maybe even start a new business. Maybe this has forced them to save the money to go and do the things that they wanted to do originally and they weren't sure how. But again, even though they haven't had a negative impact on their finances, they're thinking different things now. And they're going to need advice on that. And that leads me to my call to action. My mission, if you choose to accept it, embrace the specialist market and become the expert. And what I mean by become the expert is not just obviously familiarise yourself with the market and with lenders like Pepper Money, but also shout about it. Shout about it on your website, shout about it on social media, because it's that 43% of people that don't go to a broker when they need that help. They're the ones we need to be speaking to, because if they don't pick the phone up to you, nobody can help them. So it's really, really important we shout about it. People don't Google, I want a mortgage. They Google, I want a mortgage, but my husband's a contractor. I want a mortgage, but I was furloughed. I want a mortgage, but I recently had adverse. Make sure those keywords are there because you can help them, but you want to make sure it's very clear that you can help them because they're the ones they'll go to, the ones that say on the screen, yes, I actually deal with the situation that you find yourself in. Don't let them speak to Frank. The pubs are back open, but don't let them speak to Frank. There's never been a better time to embrace the specialist market. It's continued to grow over the years. You only have to look at 2018 to 19 there on this slide shows that the market doubled. And I think there's two reasons for that. Adverse credit has continued to rise, but also awareness has. The more lenders like us come into the space, the more brokers like you use us, the more of those customers that you help recommend to friends. And slowly, between us, we are educating the public that we're there to help. But of course, we're intermediary only lenders and they should take that advice anyway. So it is just getting more and more people to pick the phone up to you when they need that help. But it's not always about big adverse. A lot of the lending that we've always done has been more kind of near prime, sometimes arguably clean customers that are still failing credit score. And that can happen lots. That can happen for first time buyers. You must have had those customers sat in front of you where they've spent 2 years saving their deposit, they've done everything right, but they've had no reason to borrow any money, and suddenly they're failing score with a mainstream lender. You also have the opposite. You have the people who've got too much debt, actually never missed a payment at all, but they're feeling that kind of over indebtedness. Self-employed, 1 year's trading, or maybe they've changed industry. So there's lots of reasons why that kind of individual approach and the non-credit scoring model that we work on can really help your customers. And I do think that now, coming out of the COVID time, will be completely the same. I've done lots of presentations over the last 12 months around the increase in larger adverts like CCJs, over 1 million registered last year and continuing to grow year on year. But in the short term, I actually see that slowing down because, of course, there's been so much government help and so much support for customers around missed mortgage payments and the same for defaults and CCJs because they, of course, are made on things like credit cards. And all of those creditors are offering payment holidays, they're offering to freeze interest. So there's lots of support there to stop customers actually getting anything negative on their credit file. So I think in this short term, we'll see it slow a little bit. But what we will see, and like I said before around the customers borrowing their way through, we'll see an increase in those little missed payments. So let's talk a little bit about Pepper Money and how we can help you. For anybody not familiar with us, we are of course a specialist lender. We're there to help you with the cases that don't fit with the high street lenders. And that can be, as I mentioned before, an array of customers, right from your first time buyers with a lack of credit, over to your adverse credit, recent adverse credit and everything in between. and we lay it on really straightforward tiers. Now usually Pepper 48 down to Pepper 6. We currently just lend on Pepper 12 and upwards, but really transparent. So they're the amount of months that things like defaults, CCJs or missed mortgage payments need to be registered. So it's that straightforward. If you had someone who had a CCJ, whether it's satisfied or not, if it was just over 2 years ago, it would fit Pepper 24. If it was over 3 years ago, Pepper 36, etc. And we do not credit score at all. So what we never do is tier the product down for any other reason than those really transparent rules. So what it means, of course, is not only is it straightforward to explain to your customers and a real opportunity to help them, but a lot of business fits on that top tier, that Pepper 48. Because of course Pepper 48 can be used for defaults and CCJs that are over 4 years old, but it's also where everything fits when it doesn't have that level of adverse. So those customers we talked about who maybe have borrowed their way through the situation, they're now over indebted, they've missed the odd credit card payment here and there, unsecured credit will never affect your tier. So all of those customers are looking at the cheapest rates on that top tier of Pepper 48. So really straightforward, really decent opportunity to help them. And then of course repair their credit. Simply repair their credit over a couple of years and hopefully with the line to be able to move them back into the mainstream for yourself after that. So it's all about time. It's a time-based model for defaults, CCJs, mortgage arrears, whenever they were registered is what determines the product tier. And it's about time that customers were aware in the market that lenders like us and advisors like you are able to help them with those types of situations, and especially as that becomes more and more into next year coming out of COVID. It's about time that you future-proof your business. Embrace a specialist market, speak to the BDMs, and whilst at the moment that still may be over the phone or video, they're absolutely there to help and passionate about those types of customers. So speak through the inquiry, speak through it in detail, and I'm sure between us, we can absolutely help those customers. So whilst this period of time in our lives has been very different to anything that any of us have experienced before and had significant impact for us both personally, financially, professionally, it will definitely, for lenders and intermediaries, create opportunities to get closer to customers, to help them with their ever-changing needs, and we're absolutely there to support you in doing that. The new norm will have its challenges, but it'll also be really exciting. Thank you very much for listening.